Thank you and welcome to The Economy with me, Ibrahim Sani. Now, you're not having a delusion. This is, of course, me returning for the first time after a hiatus of a year away from AWANI. This show shall explore the various intricacies and elements regarding the economy of not just Malaysia, but of the world. As we all know, we are heading towards a very interesting period, not just for the fourth quarter, but generally speaking, all the areas resulting in all the fiscal reforms in Malaysia as well as around the world. There are a lot of elements when it comes to the growth of economies, the decline of economies, from the fetishization of inflation rates, for instance. So on this show, moving forward every week, I'll give you the digest of what is happening in and around the country and in and around the world, with guests from luminaries like the economists and, of course, business leaders, as well as many other people surrounding this matter of topic. For today's show, I just want to go through with you some of the items that we will be going deeper over the next few weeks, namely the fourth quarter highlight and what investors should look into. That will be covered very shortly. And of course, we want to look into the snapshot of what the economy has been performing and how the economy has been performing over the past 3 quarters. And the big one, which is the third idea that I want to share with you in this show today, budget 2025 and more. So let's move into our first big topic of the day. The fourth quarter has heralded in quite a few interesting elements into what we need to look at for closing this year off. This is the 5 things that you should be looking at if you're an investor for the fourth quarter. From the spectacular performance of the Malaysian equities this year, we're looking at how projections of fund managers and retail investors like yourselves need to look at. Let's take a look into the quick update into what has happened so far. The FBM KLCI and the FBM Top 100 Index have been on an upward trajectory, closing at 14.72% and 16.65% higher year to date, respectively, at 1,668 points. This is the highest in 18 months that we have seen this. And of course, we look at the FBM Top 100 Index, we're looking at over 12,000 index, that's 12,221 points as of last week. This is, of course, an indicator that investors are very much into the buying season, and not just institutional investors, but retail investors as well. As we saw, 99 Speedmart came in with a big IPO, and just to remind everybody, the founder just divested about 10, maybe 15% of his holdings. That is, of course, quite a fraction to what he has in control. And of course, 99 Speedmart did get a reprieve from the 25% floating requirement by Bursa. So the question then is, at least for that particular counter, will Bursa impose a timeline on 99 Speedmart to divest more shares and let it float to the public? But more than that, we're looking at investors repositioning their portfolios into the fourth quarter, and we want to know more about that element. So here are the 5 things that you need to look at. The first is, of course, on the US rate cut, because all eyes are on the US rate cut moving forward. This is because of the Fed's recent 50 basis points cut, seen at the end of an 18-month tightening cycle. Coincidentally, this is the strongest ringgit has been in the past 18 months. So we want to see what the impact is of our currency against this particular notion, if any. We're looking at the shift of a relief for emerging markets, especially whether or not this is going to have a downward impact towards all the other northern economies. And looking into 2025, majority of fund managers might want to look at repositioning their portfolio to have a more benefit towards tailwinds coming back from the Fed's monetary decision. There's also likely to see what we saw back in the 2005, 2006, when the succession of an aggressive rate hike cycle of the US monetary easing cycle is going to impact the US market as well as global markets, and of course FBM KLCI. That is an area of concern that you need to look at for number 1. Second item that we need to look at, for investors heading into the fourth quarter is, of course, the weakening of the US dollar against other currencies as well as ringgit. Considering that the Fed's rate cut of the 50 basis point that was done on September 18th, the ringgit strengthened to 4.20 against the dollar over the next 2 days or 3 days, and this has not been seen since March 2022. This is, of course, allowing foreign funds net inflow into emerging markets such as Malaysia as well as other markets within this region. And of course, this does bring about the kind of consumer staples and aviation sector, and of course we're looking at FMCG and oil and gas even, to see how this impacts that particular element there as well. And of course, we're looking at the broad Madani government roadmaps, like the energy transition roadmap, like the new economic master plan, and the Southern Johor economic zone, as well as other economic corridors, might see or attract some investors coming in even further. This is, of course, what is going to be looking at. But what I need to mention right now is some of the catalytic events, including the much revived and revamped Iskandar, as well as the advent of new technologies such as AI and the corresponding data centers that's going to be setting up business here in the southern part of the peninsula. So this is what we look at when it comes to the weakening of the US dollar against the ringgit for investors for the fourth quarter. 3 more items that I want to explore is, of course, the idea of geopolitical risks and external factors. External factors, we look at escalation of geopolitical tensions coming in not just from the Middle East as well as Ukraine, Russia, but that of North Asia, because there are escalating tensions there in the form of continuous outflow of corporates leaving China and moving into places like Malaysia, Vietnam and Indonesia that might result in the escalation of China and the US. More so now because US is still preoccupied with the political tensions domestically there, considering that the election is happening on the 4th of November. It looks like Kamala Harris is leading the race, but we never know. Donald Trump has won it once before and might pull off some strangeness there in the US political market as well. So we're looking at other geopolitical tensions as well as external factors that look around the issue of, say, potential yen currency trade and carry trade unwinding in Japan. We're looking at some other risks that might include elements of the volatility on investors not wanting to invest and hold on cash. These are the items that we need to look at for that particular elements of external risk and rising geopolitical tensions. Moving forward, we need to look into some of the recap of how Malaysian economy has been performing. So far, the economy has been resilient domestically. The economy grew 5.1% year-on-year in the first half of this year. This does put us on track for a 4% to 5% GDP growth for this year. The ringgit, as mentioned in my previous segment before we went into the break, it's at its strongest since the past 18 months. And of course, for the January to July 2024, trade has risen close to 10%, 9.8% year-on-year to reach a record high of 1.652 trillion ringgit. And of course, this is on the back of manufacturing sector growing at 1.9% and 4.7% respectively for the first and second quarter of this year. Now, we take a look into the approved investments that has been done for the first half of this year. That comes to about 160 billion ringgit. This is an 18% year-on-year increase and is set to create close to 80,000 jobs for Malaysia, as well as fresh and additional new foreign flows coming in, such as companies from AWS or Amazon Web Services, AMD, GDS, Google, Infineon, and more. Now we take a look into how this is going to impact the budget for 2025. Budget 2025 is going to be presented by the Finance Minister come Prime Minister at our date, which is on the October 18th. But one of the key elements to look into the budget of 2025 is on how Brent crude is going to impact some of the provisioning and budgeting of the Belanjawan 2025. This is because Brent crude has slipped below $70 for quite some time. And if you look at the biggest impact that we know of when it comes to Brent crude dropping or slipping below $70, does this create that room for fiscal reform to come in? Bandari government has introduced the subsidy diesel reform a few months ago, but the RON 95 subsidy removal or RON 95 subsidy reallocation has yet to be introduced. Will the government use this opportunity to introduce the subsidy of RON 95 considering that crude Brent has dropped past $70? If you look at this particular chart that I have for you, that shows the timeline between 2011 until today, the impact on subsidy has risen quite considerably post-pandemic because the economic impact or the so-called price, or the so-called economic price of the real RON 95 that is being marketed globally against the retail price, which is flattish at 2.05 ringgit, we see the gap widening quite considerably post-pandemic and much of 2023. But that has since narrowed very recently, and showing that the subsidy of that we have right now at 41 cent per litre is being subsidized. This does create an opportunistic moment for the government to introduce a subsidy rationalization right now. Because currently, when crude oil price is around $70 a barrel and the ringgit firmer against the US dollar, as I mentioned earlier before we went into the break, this does provide the government some benefits from savings on petrol subsidy as the gap has narrowed further. We're looking at this being a window of opportunity to reap savings earlier for policy redirection, and we look into RON 95 rationalization to come possibly this year, knowing that these are the arguments that we have. And of course, the margin of difference between subsidized price and market price has narrowed quite considerably enough for the government to think about this even further. A little bit more about budget 2025 is on the element of how the budget is going to attract foreign inflows into the market. Because most market experts do share that view that our stock performance have been largely driven by local factors such as Johor benefiting the construction-related and property-related companies. Data center development plans have been introduced quite some time now, and we're looking at the benefits of all these companies coming in to support us on that growth. We're looking at some of the overall positive position that Malaysia might have, which may include items like local consumption as well as SMEs driving up or promoting fiscal discipline and FDI. But we're looking at these domestic factors not to be the main driver whether it's going to be featured in the budget 2025. So the only way forward is on foreign funds and whether or not foreign funds will play a major role in generating positive momentum for Malaysia moving forward, considering that this has driven the local equity market very well thus far, as I mentioned earlier, 1,600 points and above, and this is from early January to February 27. The local stock market did record net foreign purchases of 2.4 billion ringgit, while the FBM KLCI rose to 104 points in the same period. Subsequently, from the period of April 22nd to May 23rd, the local equity market recorded a net foreign purchases of 3.7 billion ringgit, while the FBM KLCI rose 82 points. Notwithstanding from this is the profit-taking moments that have taken place over the past few months, if not few weeks, and this has made the stock market record a net foreign purchase of 1.2 billion ringgit in July, while the FBM KLCI rose 22 points. So the easiest way to capitalize on foreign inflows is to perhaps identify on some of the index heavyweights that are good proxies to the economy, such as banks and utilities, given that foreign influence are indexed or more likely to go into passive funds. So these are the areas that we can think of when it comes to budget 2025 and of course foreign flows and the possibility of window opportunity for policy rationalization through RON 95. Now there's a lot more that's going to be covered for budget 2025 on this show in the coming weeks. I'll be introducing much more of this as we go along, but for now we'll go into a short break. When we come back, we'll discuss a little bit more on what is going to happen in the next few weeks, namely RMK 13. We'll be right back after these messages. Welcome back. This is The Economy with me, Ibrahim Sani. Finally, we shall take a look into what's going to happen on the macroeconomic front. The argument right now, at least by some economists, is that there is a rising tension in the global north and their ongoing so-called Cold War, and whether or not this is going to transgress into the global south, and whether or not it is inevitable for the global south to be drawn into this so-called new Cold War 2.0. Marginalized and dominated economies, so-called by the global north, is going to ask ourselves whether or not this is going to be urgently needed for us to cooperate and better strive for us to have our shared interest in achieving this ideal notion or idealized notion of world peace, and whether or not this is going to be good for sustainable development. But before we jump into the whole conversation of what the Cold War 2.0 looks like, we should really look into the certifiable first 1.0 Cold War, when the US, NATO and other allies that is aligned to them came about and had this pretty much aggressive notion against the Soviet Union and its allies, as well as their domain or dominion controlled areas of Eastern European countries. But since the 2008 and post global financial crisis, successive US governments led by Donald Trump, Barack Obama, Joe Biden, they have all strived to sustain full employment within the US, but real wages and working conditions for the US has suffered over the past few decades. Exceptionally, using monetary authorities as an example, the US Fed includes ensuring full employment. However, without a so-called US-Soviet rivalry in the First Cold War, Washington DC no longer seeks a buoyant, growing world economy. Now, this has affected US relations with its NATO counterparties, and most of which is already hit by themselves by their own various economic stagnation since the global financial crisis. Therefore, instead of getting us to get an ensured worldwide recovery using unconventional monetary policies, we have looked into the Great Recession hitting us and enabled further financialization. And now at 2.0 Cold War, we're looking at the element of how macroeconomic situation has worsened, and this has further depressed world economy even further. Geopolitical considerations are increasingly trumping over developmental and other priorities. The global and growing imposition of illegal sanctions, for instance, has reduced investment and technology flows into the so-called global south, and of course this has created a sort of weaponization of an economic policy becoming normalized even further. Therefore, this does create that whole element of whether or not the global south is going to be further impeded by the shenanigans that is currently being happening by the global north. And of course, after the Iraq element, as well as the Afghanistan scandal, US, NATO and others often do not seek the legitimacy of their actions via the United Nations Security Council to endorse these sanctions, and because of this, these sanctions contravene the UN Charter and other international laws. This does not stop US and its NATO to continue on with these illegal sanctions, and has such been imposed with impunity across global south. This is of course coming strong against other elements of Europe, for instance, now currently NATO and the OECD or the G7 and other US-led Western institutions have increasingly undermined UN-led multilateralism, which has been set up to control and dominate. But as we know, the UN has lost its teeth and is no longer able to lead these kind of international institutions any longer. So, what can we do? What can we do when it comes to talking about the global South taking our initiative and our agency back from the elements of global North and especially this Cold War 2.0? We're looking at how that can be further exacerbated, because the global South is diverse, and because of our diversity we do face certain constraints, and this of course starts from various issues such as the poorest low-income countries are quite different from those, say for instance, in North Asia or East Asia. Foreign exchange constraints are less of a problem, but we're looking at how this is going to create even further jet tensions between or further elements of discontinuity between building a cohesive single voice for the global South to resist the new Cold War. And of course, this is indeed a big problem for us to navigate, because we look at, or at least the notion is that the Europe is still seen as a garden-facing invasion by the surrounding jungle, and to protect itself, Europe needs to attack the jungle first, and using some foreign ministers of non-aligned nations, they argue that non-alignment is irrelevant after the end of the First Cold War. So non-alignment of the old type, for instance the Bandung Agreement of 55 or the Belgrade Agreement of 61, may no longer be applicable today, and today's non-alignment should include very strong commitments and very firm idealization or institutionalization of sustainable towards the goals of sustainable development and peace, and yet we don't see that. And of course we look at BRICS, where our Prime Minister has indicated that there has been no objections from India, as well as very strong support from other BRIC member nations for us to join that particular element. So this is indeed quite important, but BRICS is quite different, excluding the less economically significant developing countries. It is not relatively represented by many of the global South countries. So this will not be much more of a factor in the global South addressing the Cold War 2.0. And of course, meanwhile, non-aligned movement remains marginalized. The global South urgently needs to get our act together in order for us to combat this element collectively. So these are the kind of ideas that is going to be discussed even further during our deep dive of this show in the weeks to come. And of course, I will definitely invite more guests to come and talk and share their views. But this is just to give you a flavor of what this show will look like moving forward. I would also like to invite you to tweet to me at Ibrahim Sani Net, or leave me some notes at Ibrahim Sani Net on Instagram to share your views and perhaps suggest some of the topics that you feel that could be relevant moving forward. I want to make sure that all voices are being represented. But for now, I'm going to call it a day, and can't wait to have these conversations even more in the weeks ahead. My name is Ibrahim Sani. This is The Economy. You're watching Astro AWANI.